Doug Andrew here. This is one of my favorite educational sessions. We're going to talk about indexed universal life, how it works, how you structure it. It is something that so many financial advisors do not understand. So put on your seatbelt. At the end of this educational session, you're going to be able to explain to a prospective client, even a group of people in a seminar, how you don't lose due to market volatility. And the biggest question people ask is, how can the insurance company afford to do that? Well, you're going to see this is not magic. It's actually quite simple, but you want to be able to learn how to explain it on a level that people can get it. So at the end, you're going to know the history behind indexed universal life, how you link your returns to an index or several indexes or indices. Those are both correct terms, by the way. And how your principal stays safe. I'm going to show you how this relates to the general account portfolio that you learned about in previous episodes. And that zero is your hero. That's going to be one of your favorite phrases that you will use. And you'll know how to answer the question, how can the insurance company afford to do that? Well, they are big boys and girls. They know what they're doing. And you're going to understand that this is a no-brainer once you understand how to link your returns to an index. Your money's not invested in the market. It's linked to what the market is doing without your money at risk in the market. Now, some people say, that sounds too good to be true. No, it's really not that complicated if you pay attention here. So as we proceed, what I want to do is, first of all, give you Indexing 101. And in the next episode, I'm going to talk about lock-in and reset. In this one, just stay with the basics here. If you have a choppy market, and I'm not going to use a volatile one in this episode of markets dropping 40%. I'll do that next. Let's say the market over a 10-year period goes up 10%, down 10, up 10, down 10, up 10, down 10 for 10 years. Now, if you told that to most people, the market went up 10, down 10, up 10, down 10. So what was the net return at the end of 10 years? Most people would say zero. No, you lost money. What? Here's why. If you have 100,000 when you start, and it goes up 10%, it goes up to 110,000. Now, if the market loses 10%, you lose 10% of 110,000. That's 11,000. You take 11,000 off of that, and you're down to 99,000. You're not back to break even. The market goes up 10 and down 10. You're down to 99,000. You do that 5 years up, 5 years down, and you only have 95,000. See, most people think, well, it goes up 10, down 10, up 10, down 10. You're back to the 100,000. No, you're down to 95,000. Now, wait till you see the next episode when I show you 30 and 40% drops. Because if the market goes up 50, down 50, up 50, down 50, most people say you're back to zero. No, you're not. You're way down. So in this example, this is what people experience in a choppy market. And this is actually quite conservative, just up 10, down 10. What if you could participate when the market went up? So the market goes up here, and then the market drops down 10, and you do not lose the 10% you made here. You don't make anything the next year. Zero. You make zero, but you don't lose. So you keep your 110, and then the next time it goes up, 2 years later, it goes up 10, it goes up to 121. And then when the market drops 10, you don't lose a dime. You don't make anything, but you don't lose. So the same 10-year period, 5 years you made money. 1, 2, 3, 4, 5. 5 years you make money. The other 5 years you don't make anything, but you don't lose. What's the difference? You have 161,000 at the end of the day in this. You only have 95,000. You don't even have your original 100 grand when you're in the market, okay? So what's the difference here? The average return people say they're getting is 10%. No, the actual return is a minus almost 5% down here. Up here, I have 161,000. So this is indexing simplified. This on top is where you make money when the market goes up. You don't make anything when it goes down, but you don't lose. And as I said, Will Rogers once said, people get more concerned about the return of their money instead of the return on their money when things are going bad. So far, so good. Now, this is 69% more money by using this strategy. This is indexing simplified. You ready for the meat? Here we go. So you've learned so far about the GAP, the General Account Portfolio Yield. So let's say, and I'm going to actually use the worst decade since the Great Depression, 2000 to 2010, to illustrate, because if I can show you how phenomenal this performed in the worst decade since the Great Depression, basically you'll see that this can perform even way better than I'm going to illustrate. So during that decade, 2000 to 2010, I had universal life insurance policies, indexed UL, with several different insurance companies. I'm going to show you one of my favorite. This happened to be a company that's been around for more than 150 years. It's the company that manages over $3 trillion, as much as the IRS collected in income tax annually in a given year during that decade. And so these are huge insurance companies. Their general account portfolio yield on that $3 trillion back then was averaging between 8 to 9% during the 20 and 30 year period that they offered indexed universal life. During the lifetime that I've sold universal life, ever since 1980 till today, okay, it's been 50 years. I have seen general account portfolio yields as low as 5% and as high as 17%. Now, on the average, if it's 9, we net 8. Now, in that decade, the last 10 years, that decade of 2000 to 2010, the general account portfolio yield of this insurance company was a little bit north of 6%. So let's just round it down to 6. So they're earning 6. And they need one of those percentage points, remember, for them, for their profit. The remaining 5% is what they pay me on my indexed universal life insurance policy. That is the interest that they are crediting my policy. So far, so good. Now, I'm going to use an example of $1 million here. So this is indexing simplified. I have $1 million of cash value in my policy. Now, people sometimes go, whoa, you threw in $1 million? I could have, but remember, to comply with TAMRA, the fastest I could fund it would be $200,000 a year. Or if I made a mech out of it, I could put it all in at once, but then it's not tax-free when I take it out. So let's just assume that I've been socking away, $10,000 a year or $50,000, or I put in $100,000 a year for 5 years, and then it doubled the next 7 years to $1 million. I'm going to take a snapshot in time, and in the year 2000, I had $1 million of cash value. I could have been funding that for 20 years, 30 years prior, or I could have funded it 5 years earlier. All I'm saying is, let's say in the year 2000, you had $1 million of cash value. And whenever I use an example like this, if you're sitting there with $1,000 a month, you're going, oh, this is out of my league. No, you extrapolate from my example. If you have 100,000 instead of $1 million, you take 1/10 of my example. It's still relative. If you have 10 million, you take 10 times my example. That's how you extrapolate. So let's say you have $1 million of cash value in your insurance policy. It's an indexed universal life, and it's the year 2000. And so you're clicking along and you go, they're paying me the net of 5%. So that means I can just sit back and play it safe. And if I feel bearish about America, I think we're headed for a recession or tough times, I can just settle for the for sure 5%, which would be 50 grand. It can grow, and at the end of the year, I have $1,050,000 compounding. Or I can take it out. It's tax-free. Doesn't matter. That's the general account portfolio rate. I can do that anytime I want. But let's say I feel bullish about America. Now, I'm going to fast forward and I'm going to use the year 2011 for this example. In 2011, I felt bullish about America. And with my policy with this company, I decided to link in November of 2011 to an index that they offered. Okay. So I can link to an index. Now, what's an index? It's a measuring tape. Okay, it's a way to measure, did the economy go up this year or did it go down? And you're beginning at a certain point. I began on November 15th of 2011. That was the linking date. So you're going to learn in future episodes that you can have linking dates on a monthly basis, dollar cost average, and so forth. But I linked November 15th of 2011. Any idea why I did that? What was 2011? It was an election year. What was unique about that election year compared to some other election years? An incumbent, President Barack Obama, was running for his second term. Historically, it's a no-brainer. Anytime a president, Republican or Democrat, runs for their second term, an incumbent runs for their second term, they do all kinds of fiscal and monetary policy to make the economy vibrant, boomed, dynamic to get reelected. I knew my chances were far greater that it was going to be a great year and that I ought to go for it. But if I guessed wrong, and something out of his control happened, like another terrorist attack, like 2001 happened, I wanted to protect myself if I guessed wrong. So I went ahead and linked. This is what happens when you link to an index. That year, I actually linked to several, but let's use the S&P 500. It's a measuring tape, so it could be the Standard & Poor's 500, the top 500 companies. I could have linked to the Dow Jones, the top 30, the Russell 2000. This company has the Barclays U.S. Dynamic Balance Index. That's called the BUDB. This company has like 15 indices you can choose from. Let's just use the S&P to keep it simple. So if I link to the S&P 500, and let's say the S&P was at 1,000 on November 15th of the year 2011, which was pretty close to where it was. I wait 1 year later, just after the election, to November 15th of 2012. And the insurance company measures what did the S&P do on that November 15th of 2012 compared to 1 year earlier. Now, guess what? It was just like I predicted. It went up over 16%. But they capped me at 16%. If it went up a year later, 10%, the insurance company is obligated to pay me 10%. So that means they would have to pay me $100,000, not $50,000, and that's tax-free. So how did they do that? If it goes up 10%, they have the wherewithal. Here is the important point. When I link to an index, I am not authorizing the insurance company to take one dime of my $1 million and invest it in the market in the S&P. No, I'm linking it to the S&P. That's the measurement we're going to use. People go, huh? What am I giving up? I am relinquishing the for sure 5% in this example. I'm saying to the insurance company, don't you dare risk my $1 million. I want that $1 million at the end of the year. You can do whatever you want with the interest on the $1 million, $50,000. You can do whatever you want with the $50,000 to have the wherewithal to pay me whatever the S&P does if it goes up. Oh, so the insurance company, it's a no-brainer. They're off the hook to keep the $50,000 on hand. They have that. And they have to pay me what the S&P does. So what are they going to do with the 50 grand? Hello? They're going to buy upside options in the S&P 500. They're the #1 purchaser of options in the world. They buy them hourly. So they take my 50,000 and they buy options. So that if the S&P goes up 10%, if it goes up to 1,100, they have the wherewithal. This 50 grand of options matures to 100,000. They're not out any money. If it goes up 15%, they pay me $150,000. But they cap me at 16% that year, even though they earn more than that. Now, why do they cap me at $160,000 or 16%? Because I did not let them use my whole million. That's hard to earn more than 16% if I don't let them use the million. They only can use the interest on the million. So options sort of restrict them. So they have to cap me. It's called a cap. So that year the caps were 16%. So they capped me at 16. What's the trade-off? If I guessed wrong, what's guessing wrong? Let's say a terrorist attack happened. And like happened in 2001, or let's say a mortgage meltdown happened like 2008, and the market drops 40%. People who have that million in a variable product in the market, that million goes down to 600,000. That happened twice in that decade from 2000 to 2010. If that happens here, my million is safe. I don't lose a dime. I may not earn anything. I earn zero. The options that 50,000 purchased expire worthless. But I didn't lose my million. I earned zero, and zero was my hero because everybody else in America lost 40%. I didn't lose a dime. I didn't make anything, but I didn't lose anything. Isn't that incredible? So they cap you, and that gives you a floor. Now, the higher the cap, okay, the lower the floor. Now, I can lower the cap down, and I can raise the floor, and I'll show you a few of those situations. I don't want to get too complicated here, but I want to show you how you diversify among superior alternatives. So far, so good. So that's what happens when you link to an index. Your money stays safe in the insurance company, earning 5. You are relinquishing the 5 and letting them buy upside options so that if the market goes up, they have the wherewithal to pay you. That's how they can afford to pay you. If the market goes down, the options expire worthless. So when somebody says, how can the insurance company afford to do that? Well, they're not out anything. You allow them to be able to buy upside options, but see, your money is safe in there. They're not paying you money that they lost. No, your money stayed safe. So let's fast forward. That's called a 0% floor. I'm going to use a 15% cap. At the end of the decade, 2000 to 2010, the worst decade since the Great Depression, the caps came down to 15%. So let's use that one. Do you know during the worst decade since the Great Depression, 2000 to 2010, instead of 7 up years compared to 3 down years, the average for most decades, we had 5 down years and only 5 up years. If you sat there and 5 years, what were those 5 years? 2001, the terrorist attacks, 2002, 2003, 2007, and 2008. I earned 0. I earned 0, but I didn't lose. That means the other 5 years, I made money. Only 2 of those 5 years did I cap out. Do you know what my average return was? 7.23% in the worst 10-year period since the Great Depression. If you know the rule of 72, if I started out in 2010 with $1 million and I never added a dime, if I was Rip Van Winkle and fell asleep in 2000 and woke up in 2010 and what happened while I was sleeping? What, you never heard about the terrorist attacks of September 11th, 9/11? What? No, what's 9/11? Isn't that the number you call when there's an emergency? No, that was the terror. You didn't hear about 2008, the mortgage meltdown? Everybody lost 40%. They're still not back to break even. And you get concerned. And you go look at your indexed universal life. And you go, really? My million is now worth $2 million. Because rule of 72, 7.23% divided into 72, in 10 years, your million doubled to 2 million. That's what happened just by using indexing. I'm about to show you how our clients tripled their money, especially by 2012. Most of our clients had 3 million by the time most people barely had their original million back. It was called the lost decade. It was actually a 12-year period. So this is called a 0% floor. This one was a 15% cap. The average in the worst decade was 7.2%. Now, you ready? The insurance company has several different choices. At the time, this one had another one, a 2% floor. Oh, so if the market crashes, they'll still pay you $20,000 on your money. They'll still pay you 2%, which is twice what banks were paying. Banks were only paying 1%. Oh, if you want a for sure 2% tax-free, you can do that, but now the cap comes down from 15 to 13. The higher the floor, the lower the cap. So now the most they'll pay you is 13% if the market goes up, but they will pay you at least 2%. Okay? Do you know the average is 8.11% for the previous 30 years using that strategy? Oh, here's another one. Are you ready? I'm going to take the floor back down to 0. I'm okay with earning 0. I just don't want to lose. You take the floor back down to 0, and now they have the full 50,000. And this one here, they had to keep 20,000 on hand. They only had the remaining 30,000 to buy options. That's why the cap is less. Here, they have the full 50,000 because you chose a 0% floor. But we kept it at a 13% cap. How come? Because the insurance company says, if you'll give us a full 50,000, all of your interest, and a 0% floor, and you keep the cap at 13 instead of 15, we will pay you 140% of whatever the S&P does. This is for volatile markets. Now, people get blown away right now, and they start checking out on me. Don't do that. The insurance company pays me 1.4 times whatever the S&P does. So if the S&P goes up 10, I actually get 14 because they pay me 140% of whatever the S&P does, even though they cap me at 13. So I actually don't get 14. They cap me at 13. But if I am earning 5, I get up into the 7% range, 7.5% range, and I'm able to get 140%, 1.4 times whatever the S&P does. Okay, I've probably given you enough to chew. So here's the most common question I get asked. Doug, which one did you use? Are you ready? All of them. See, some people define diversification as having your eggs in all these baskets, and some of those baskets have rocks in them that cause the other eggs to break. Oh, you ought to be diversified. I said, where? In a bank earning less than 1%, and it's 6 times less safe. Most insurance companies are 6 notches higher in safety. They're rated AAA. A lot of banks aren't even rated BBB. And so I had my money, I could have a third of my money here, a third here, a third here. I had all of them, and I averaged 9.62% by having some here, some here, some there, because I diversify into a superior vehicle. You want to know about diversification? I have my money in these indexed universal life policies, some on me, some on my wife, some on my kids. I have some with this company, some with this company, some with this company, some with this company. But with this one company, I have some in this one, some in this one, some in this one. I sometimes choose 5. So I diversify in superior vehicles, and I tweak my rate of return. So far, so good? You just learned something that most advisors have never been taught. So let me summarize all this and show you how important this is. I'm going to show you an actual annual statement of an actual client of my son's who had in his insurance policy 5 different places where he diversified his money. So if he was putting $100,000 a year into the policy, he was saying, I want 20% of my cash value to be linked to the Barclays U.S. Dynamic Balance Index. That's called the BUDB. Down here, he chose to put another 20% of his money in the S&P, annual point to point. You're going to learn what these mean. Down here, he had another 20% in the NASDAQ 100. He had another 20% in the blended index, and he had another 20%, the last 20%, just sitting in the insurance company earning the general account portfolio rate. At that time, it was 4.4%. So he diversified by having his money split up 20% in 4 different indices and then 20% in the general account portfolio. The average of all of those was over 10% that year tax-free. This one he earned 13.65. This one 11%, this one 9.5, this one 15, and this one 4.4. How simple was that? On one sheet of paper, he diversified and ended up with over a 10% rate of return that year tax-free. That's diversification. And that's what indexing can do. So when you look at this, we've talked about fixed universal life, indexed, and variable. Fixed might give you a guarantee of 3. Indexed, 0 is your hero. Variable, there is no guarantee. The lowest I've earned on fixed contracts has been around 4. With indexing, 0. With variable, I've seen people lose 50% in one single year. But since the year 2000, fixed has averaged 6.3, index 8.47, variable 1.81 during that worst period. The highest that I've seen fixed is 13.75 with this company. With indexed, 39.22. I have another one where indexing credited 55% one year. Variable, 35%. But here is the 25-year average at this point in time. And this, again, is one of the worst 20-year periods. 7.5 is what you would expect in a fixed. With indexed, 10.07. With variable, only 9.14. Which one would you choose? I like this one because I don't have heartburn with the ups and the downs, and I actually come out ahead. So when you look at indexing choices that you're going to learn about in further episodes, you can choose some that have a 0% floor. You can look at the 30-year average, and the current cap is 13. Here's a 2% floor, a 12% cap. Here's a 0 and 11.2, but you get 140% participation in the market. A 0% floor, a 16% cap. Here's a 0 and no cap. You can get up to 65%. And people say, which one should I choose? Well, diversify in all of them. But if you have a really savvy financial advisor, which I hope you're going to become, you can help your client diversify. And we're going to talk about rebalancing here in a few episodes, where you rebalance between these depending upon sort of the signals in the economy. But if you were to put your money in any of these or diversify and fall asleep for 10 years, look at the average rates of return, 8, 7, 7, 8, 8. It's pretty predictable. Hello? Even if you never rebalance, that's not bad. But when you rebalance every year or two, this can be tweaked up to 9 and 10%, and that does make a difference over the long haul. So that is the magic behind a max-funded indexed universal life insurance policy, a bucket. And when it's structured properly and you link to an index or indices that the insurance company offers, you're able to increase the rate of return. But some years when the market goes down, you don't make anything. Or you make a very small amount if the floor was 2%, but the cap will be lower. But your general rate of return, I have found since 1997, will be about 2% higher than just sitting back and accepting the fixed or the general account portfolio rate on a fixed universal life. Variable, I don't want to go through the volatility and the heartburn. Life's too short to do that. So now you know how indexing works. Your money is not at risk in the market. It stays safe in the insurance company. It may earn 5 or 6%. What you're giving up when you link to an index, any year you do that, and you can change every year, you're only relinquishing the interest on your money. And any year you make money, you will lock in that gain and reset, and that's what we're going to teach in the next episode.